Hey there, are you planning on buying a home soon but worried about how much debt might affect your chances of getting approved for a mortgage? Well, you're in luck because today we're going to talk about some types of debt that aren't considered debt when applying for an FHA loan. That's right, not all debt works against you, and knowing this can make a huge difference in your approval process. By the end of this video, you'll have a clear understanding of what type of obligations won't count against you so you can feel more confident in your home buying journey. If you have any questions along the way, remember you can book a time with me or my team using the link in the description below. We are here to help you every step of the way. Let's start with a quick refresher on what an FHA loan is. FHA stands for Federal Housing Administration. These loans are popular among first-time homebuyers because they are more accessible, offering lower down payment options and more flexible credit requirements compared to conventional loans. But with any home loan, lenders will take a close look at your debt to income ratio, or DTI. This ratio helps lenders determine how much of your monthly income goes toward paying debt. But here's where it gets interesting. Not all debts are counted as part of your DTI. So what does count as debt when applying for an FHA loan? That's what we're diving into next. Now let's talk about those specific obligations that won't hurt your DTI ratio when you're applying for an FHA loan. According to FHA guidelines, the following items are not considered debt obligation. Medical collections. So if you have unpaid medical bills and collections, don't worry. These are not factored into your debt to income ratios for FHA loans. The FHA understands that medical debt can be unpredictable and shouldn't stand in the way of homeownership. Taxes. Federal, state, and local, if not delinquent, as long as you're current on your taxes and not required to make any payments on your tax obligations, that won't be counted as debt. This includes federal, state, and local taxes. Automatic deductions from savings. So any automatic withdrawals from your savings account that are not tied to another type of obligation won't be counted. For example, if you set aside money automatically each month into a separate savings account, this won't negatively affect your debt calculation. Retirement calculations, FICA and 401k. So contributions to your 401k or any retirement plan, including FICA, are not considered debt either. This means your efforts to save for the future won't hurt your ability to buy a home now. Collateralized loans secured by depository accounts. So if you have a loan that's backed by money you have in a deposited account, such as a secured loan using your savings as collateral, this type of loan doesn't count against your DTI. Utilities. So your monthly utility bills, such as gas, electric, and water, are not considered debt either. These are living expenses, but they don't affect your debt to income ratio. Childcare cost. So if you're paying for childcare, the FHA does not count those expenses as debt. We know how costly childcare can be, but in this case, it won't hurt your home loan application. Commuting cost. So your daily commuting costs, whether it's fuel, parking, or public transportation, aren't counted as debt. This is great news for anyone with a long commute. Union dues. If you're part of a union and pay regular dues, these also won't be considered a debt obligation. So keep doing what you're doing. It won't hurt your mortgage approval chances. Insurance, other than the property insurance. So any insurance payments you make except for property insurance are not included in your debt calculation. So life insurance, health insurance, or even vehicle insurance won't stand in the way. Open account with zero balances. So do you have credit cards or other accounts with zero balances? You can rest easy knowing that these accounts won't be considered as part of your debt load. Voluntary deductions, so not tied to another obligation. So if you have any voluntary deductions from your paycheck that aren't tied to another obligation like charitable contributions or voluntary benefits, these won't count either. These exclusions can make a huge difference in how much home you qualify for, so it's important to be aware of them before you even start applying for loans. Why does this matter for you as a potential home buyer? Well, it could mean the difference between getting approved or denied for a loan, or between qualifying for a smaller or larger home loan. So by understanding what type of debt don't count, you can better manage your financial profile and improve your chances of securing the loan that you need. Also, not having to worry about certain expenses like medical collections or utility bills gives you more flexibility to focus on your true financial obligations. So this allows you to paint a more accurate picture of your financial situation when applying for a mortgage. This also means that you can focus on paying down the debts that do matter, like credit cards or personal loans, without getting stressed about things like taxes or childcare costs that won't affect your loan eligibility. So if you're thinking about applying for an FHA loan and have questions about your debt or finances, we are here to help. Our team is committed to helping you finance the home of your dreams, and we'd love to walk you through the process step by step. So, whether you're unsure of your debt to income ratio or need advice on your financial situation, book a time to chat with us using the link in the description below. We'll answer any questions you have, and together we'll figure out the best way to move forward on your path to homeownership. Thanks for watching, and if you haven't already, make sure to like, subscribe, and share this video, and we look forward to talking with you soon.